I'm sure this example is quite useful. Now, moving on, let's try and understand derivatives meaning from the stock market perspective. Derivatives are trading instruments such as security derived from a debt instrument. It could be a share, it could be a loan, or any risk instrument or contract for difference of any other form of security. Yeah, also it's actually a contract between two people. Yeah, a contract that derives its value from the price or index of the price of the underlying asset. A simple example: stocks, equity. It can be index, it can be nifty, yeah, it can be sensex, it can be bank index, it can be currency, yeah, either Indian rupee versus dollar, euro versus pound, it can be anything, yen versus dollar, it can be anything, or even commodity like gold, silver, crude, it can be anything. So in all these financial instruments we have financial derivatives available for us. Now, what to trade? Now, again, derivatives is a vast subject. This is actually a huge subject. We are not exactly getting into this subject with absolutely an academic interest. Here, we'll be purely learning from trading perspective. How do I trade it on National Stock Exchange? Yeah, how do I actually I apply this and trade and actually make money? From that perspective, we are narrowing our learning only to that extent. Here I'm not actually making this video to take an exam or write an exam or know academically. No, that's not my key intention. My intention is that to make you comfortable trading, you should be able to put trades comfortably, understand the risk and understand the return. Now, what are the various instruments available? First is there are two index which is available. One is we have Nifty 50, which is available. Nifty, that's the index which is available, and Nifty Bank Index. It's a set of bank stocks which are put under Bank Nifty Index that is available for trading. Then there are 141 stocks. Currently, you know that National Stock Exchange has 4,000 stocks. Bombay Stock Exchange has more than 5,000 stocks. But in National Stock Exchange, right now we have about 140 to 141 stocks which is currently available, and only two index which I told you. And then all these have options. We'll come to options in detail as we move ahead. Right now, we'll be focusing our learning on futures contract initially, and then we will be moving on to options. Now, there were a lot of derivatives in mid cap, PSC, IT index. All these were tried, but only because of lack of volume, that is lack of participants. If I'm not selling the contract, if I'm not buying the contract, there is no point. It will not exist, it will cease to exist, because there is not much of an interest. All these are withdrawn, taken back, and currently there are only two indexes, as I told you. Nifty 50 as well as bank index is available for trading on National Stock Exchange platform, which has substantial volume on a daily basis. Now, these are the instruments which we can trade. Now that, okay, all these are fine, but what's in it for me? As I told you, what is the objective of this class? What is the objective of this education? Now, the objective is very simple. We are going to learn how is it traded, how do we calculate profit and loss, how do I make sure that I understand the profit and loss, my risk, what is the risk involved. These are some of the things. Our learning will be limited to how it is traded, P&L, and then risks. What kind of risks am I exposing myself to? So these will be the topics which we'll be covering as of now. Now, first, to understand every contract, as I told you, it's not an, it's actually a contract between the buyer and seller. Now, these contracts will have a lot size. We are going to learn about lot size. I'll be talking about lot size. Now, obviously, this lot will have a contract value. When I say SBI is currently 185 rupees per share. It could be 200 rupees per share. But when it comes to a lot, SBI will be a lot of 3,000 shares. Now, I'll have to multiply this 185 into 3,000 to actually arrive at the contract value. Now, it's not the full value. If I have to buy one share of SBI, I shell down 185 rupees per share. But when I'm buying this contract, I don't pay the entire value of the contract. I only pay initial margin, which is a percent of the contract value. It could be 20%, it could be 25%. Yeah, it can be 30%. I only pay the initial margin. Then, based on the stock price movement, even Even derivatives will also have its movement because it corresponds to the base price, which is our underlying asset. Yeah, that is also called as the spot price. Based on the spot price movement, derivatives also correspond. And then based on the movement, we will have mark to mark settlement to be done. What do you mean by mark to market? Suppose example, I'll be covering it in depth, but here I'll just give you a brief introduction. I buy SBI at 200 rupees and it has fallen to 190 rupees during the day. The 10 rupees, if you have bought, the 10 rupees is minus from my initial margin, which I have to replenish. If there is a call for margin, I'll have to replenish that difference amount. So that is what I need to do. So this is about the mark to market settlement. Also, if there is a positive movement from 200 rupees to 210 rupees, if there is a positive movement, obviously that will be credited to my account. It will be there in my derivatives account, but I'll be able to use it only when I actually close the contract. Only the obligation is when it is in minus negative balance, which I have to replenish. If I don't replenish, then the broker will actually, close the position for me. He won't continue because it's a risk which you are carrying. So we will be studying this in detail. We'll be understanding this in detail in real time scenario, but this is basic understanding. So we will be learning about a lot about how it's traded, the P&L, risks involved, what lot size we are talking about, what contract value we are talking at any given point of time, what is the initial margin that is required, and how settlements are being made, mark-to-market settlements are being made. Now, what is a future contract? Revisiting this, what is a future contract? It's nothing but, there is a specific date in a calendar and there is a fixed price at which you are entering. Like you say, I say, I'm ready to buy this at this price, and somebody says, I'm ready to sell at this price. So you need two people, a buyer and a seller. There is a fixed date at which it expires, or until then it's valid, and there is a price at which they have agreed. This is what makes a future contract. Now, taking it further, at any given point of time, there are always three contracts which will exist. So that is three fixed time. The first thing we will understand is every month, the last Thursday, these contracts expire automatically. For example, in the month of October, the last Thursday of October, it will expire. November, the last Thursday. December, the last Thursday. It's the same. Exactly at the expiry of the current month contract, that is the last Thursday, a new contract for the third month will be created. Now, what are these three month contracts known as? One is the current month. If I'm in the month of October currently, it is known as the current month contract. Then the November will be called as a near month contract, and December will be called as a far month contract. Now, as we have understood, when will be the January contract be created? On the last Thursday of October. As soon as the October contract expires, January contract will exist. Yeah, that is how it will be created. That is how it will begin. So the first key learning here is it's a contract between two people. There is a fixed price and there is a date at which they've agreed on. So the date of expiry is the last Thursday of every month. As we understood earlier, this contracts will have a lot size and the contract value. Now, how do we understand this? I would like to take example of SBI, State Bank of India, which we all understand very easily. As we know that the current month contract will be known. This is the exact way. SBIN is the code. October FUT, which means State Bank of India October futures. Similarly, November and December. This is how you will be able to search for these contracts in your trading screen. And then what exactly? Now coming to the lot size, each share or underlying asset will have its own lot size based on the value. Whatever was the base period when it was created initially, earlier the contract value was taken as 2 lakhs. When it was created, the contract value was 2 lakhs. So the number of shares, it was divided up with the value, the current value was divided with the with 2 lakhs, and then they would arrive at the lot size. Over a period of time, the value of the shares have increased, and there are various, each contract you will find at a different value. For example, SBI is currently valued, is actually 3,000 shares is one lot size. Similarly, just to give you an example, Mahindra and Mahindra is actually 1,400 shares will be one lot size. Now, to understand this, there are 3 contracts available at any given point of time, and each contract, will have a lot size different. 141 stocks will have a different lot size uh, for our understanding. Now, coming to the contract and expiry, there are 3-month trading cycles. The near month is called as number one. It's number one is near month. Number two is actually next month. And number three is actually the far month. So Nifty 50, only this Nifty have weekly options like Nifty as well as bank has weekly. Only the index will have weekly options. What do I mean by weekly options? Just like I told you, the last Thursday of the month, Nifty expires or all the contracts expire. Nifty in addition, Nifty and the index, both bank will have weekly options, which means on every Thursday there is expiry of a weekly contract. So every Thursday, this uh, weekly contracts expire, which will have a special pricing that will be traded as a different instrument. In case the Thursday is a trading holiday, the previous trading day shall be the expiry, which means if Thursday is going to be any national holiday, the exchange is going to be closed. The expiry falls on the Wednesday, and all contracts shall expire at the normal closing time and at the expiry day or such time as decided by exchange. The settlement, basically it's also called as the settlement usually happens at the normal market closing time. Yeah, and then based on the pricing between the 315 and 330, the average price of that will be the closing value. So exchange guarantees settlement. Exchange actually guarantees this settlement. It is based on the closing of the spot market. Now, again, revisiting this, let's try and understand. Let's try and understand what exactly we're talking here. How do I arrive at the contract value? The first and the foremost, like, well, let's try and understand what exactly happens here. Okay, now we know that there are 3 contracts available, that is in the month of October, November, December, and as soon as the October expires, January is created, and each of these contracts have lot size. Now moving on, let's try and understand what's the contract value. The contract value is nothing but lot size multiplied by the futures price. The futures, there can be a difference between the futures price and the spot price. We'll learn that also. So let's say SBI has a lot size of 3,000 and the current price is about 180 rupees. Then obviously the contract value is 5,40,000 on a given date. Yeah, so it's exactly, it multiplies that. Now, what I say, this is how a typical contract, when a typical futures contract look like. Now, this is how a typical futures contract look like. So basically, today we are on 6th October 2020. Let's assume we are on 6th October 2020, and I'm looking into futures contract of SBI. The current spot price is 180 rupees. The current spot price is 180. And I go and look into the screen of the stock market and I see October futures is priced at 181.40 paise. And then November is 182.20 paise. And December is 183.50 price. Now you all know that all these contracts are getting expired on the particular month, on last Thursday of the particular month. At that time, the settlement will happen based on the spot price, which is the current price in the stock market. Yeah, not in the derivatives market, but in the spot market. Now, how do you know this? When you visit the stockbroker screen, that is where you will actually, when you look into the calendar, if I'm looking into the 6th, I know the 29th October of 2020, which is the last Thursday, the contracts are expiring. Now, how do I trade this? Now, this is where I can actually, it's a contract. It's not like, in a stock market, if I have to trade in equity, I need to have delivery of shares to go short the stock. In equity markets, it's very simple. You just go buy. If you feel that the prices are going to go up, you actually end up buying stocks in equity market. But what if the prices are coming down? What do you do in equity? Yeah, if I have to sell any share, I have to have delivery of the share. If I don't have physical shares of that, I won't be able to actually sell it. Physical here, I actually mean in demat account. If you don't possess those shares with you, you won't be able to sell those shares. This is exactly the advantage in a derivative market. What happens in derivatives market, based on my view, if I feel the market is going up, I can as well buy the contract. If I feel the market is going to come down, I can sell the contract, which is known as shorting or short selling. Short selling is allowed in derivatives market. Unlike cash market, where I need to have those shares in my demat account. Otherwise, it will go for the auction. And I'll end up paying the penalty. I'll end up paying the interest. All those, there will be penal charges which I have to pay. Whereas in a contract, I'm open to buy as well as sell based on my view. If my view is, looking at 6th October 2020, I feel by month end, from the current 180 rupees, if it's going to come to 176 rupees, I can as well sell today and buy. Or when the contract ceases or settles, it will be bought for me at the closing price. So based on your view, you can actually get into a trading.